Hey everyone, today we're diving into a crucial topic, how to properly navigate Bitcoin's downtrend. According to a professional quantitative trading report, BTC is currently in a textbook strong bearish trend. What does that actually mean? And more importantly, how should you respond? Over the next few minutes, I'll break down the key insights from this report in plain, simple language. Let's start with the big picture. The report uses a machine learning model to label the current market state as strong_trend_bearish, essentially a powerful downtrend. This classification carries a 90% confidence level, with trend strength at 0.93. In plain terms, that's an extremely clear signal. Put simply, the bears are firmly in control right now. You might be wondering, how can they be so sure? The key lies in multi-timeframe alignment. The report analyzed 4 different time frames, 1 hour, 4 hour, daily, and weekly, and the results were strikingly consistent, all pointing bearish. Imagine 4 red lights flashing at once across all major traffic signals. This kind of alignment is rare in trading, and it significantly boosts confidence in the analysis. Now let's look at some supporting indicators. The Fear and Greed Index sits at 34, which is in fear territory, reflecting a pessimistic market sentiment. The 24-hour market cap change is negative, indicating overall weakness. These macro data points echo the trend analysis, making the bearish case much more convincing. But here's the thing, knowing the direction is only step 1. Execution is where the real skill comes in. The report lays out a crystal-clear strategy: trade with the trend by going short, and absolutely avoid catching the falling knife. A lot of retail investors see a big price drop and instantly think, is it time to buy the dip? But the report emphasizes that in a strong trend market, oversold indicators like RSI and KDJ become unreliable, they're not valid reasons to buy. Remember this golden rule: the trend is your friend. Don't fight it. So where exactly should you short? The report provides key price levels. The ideal entry zone is between $63,030 and $63,200, as this area aligns with dense moving average resistance on the hourly chart. In other words, if price bounces into this zone, that's our opportunity to short with the trend. The stop loss is set at $63,400. If price breaks above that level, the thesis is wrong, and you need to exit decisively. The take-profit targets are equally clear. The first target sits at $62,680, which is the recent low. The second target is $62,000, a major psychological level. From entry to target, this trade offers a risk-reward ratio of roughly 1 minute and 1.8 seconds, meaning if you're right, you stand to make nearly twice what you risk. In the trading world, that's a solid setup. As for position sizing, the report recommends risking just 2% to 3% of your total capital. Why so conservative? Because even though the trend is strong, volume data reveals some concerning signs. The report specifically notes that the current rebound is happening on very low volume, only 0.36 times the normal level. That tells us buying pressure is weak, making this bounce fragile and prone to failure. Here's a detail that's easy to overlook: price and volume are diverging. On the daily chart, the price-volume correlation is negative, and on the weekly chart, it's at minus 0.68. What does that tell us? It suggests the downward momentum may not be as strong as it appears. Yes, the direction is down, but the journey could be choppy. That's why the report advises against chasing shorts aggressively. Instead, patiently wait for a bounce into resistance before entering. What if price doesn't bounce and just breaks down through support? The report has a second plan ready. If the 4-hour candle closes below $62,681, you can technically short the breakdown. But this is a secondary strategy because chasing a breakdown carries more risk. If the trend has already traveled a significant distance, jumping in late could mean catching the bounce after a sharp drop. So unless signals are exceptionally strong, the preferred approach remains shorting into strength. Here's an interesting data point. The report also analyzed taker-buy-sell flow. The current taker-buy ratio sits at 53.7%, which looks like buyers have a slight edge. But when you factor in the extremely low volume, this looks more like a bluff than genuine accumulation. Real bottom reversals typically come with surging by volume, the current numbers just don't support that. These tentative bids could easily get steamrolled by sellers at any moment. The report also includes what I think is a highly practical, short verification checklist. Before entering a trade, you should confirm several conditions. First, price bounces into the $63,000 to $63,200 zone. Second, the taker-buy ratio remains below 55%. Third, volume hasn't significantly expanded. And fourth, the 30-minute MACD shows a bearish crossover. When all four line up, the odds of a successful short improve dramatically. A lot of newcomers ask, what if I just hold my spot and do nothing? Well, it depends. Looking at the weekly trend, the bearish structure is crystal clear. Holding spot means you're essentially swimming against the current. However, if you have a high tolerance for drawdowns and don't want to trade actively, sitting in cash is perfectly acceptable. As the report puts it, staying on the sidelines is also an excellent strategy. The report also ran a quick analysis on ETH and found that its correlation with BTC is currently neutral. What does that mean? It means the bearish thesis on BTC is relatively clean. You don't need to worry about ETH suddenly surging and dragging BTC along. So if you're primarily trading BTC, the environment for executing this strategy is fairly straightforward.